Hi, everyone. Thank you for coming, and thank you to the organizers. This is my first Startup Boston, so very excited to be here. I'm Danielle Silva. I'm SVP of Life Sciences at PacWest, and today we will be talking about money, one of my favorite topics as a banker. We will be talking about essentially how to pitch investors, what should be in your pitch, and more importantly, how to network with investors. So I am going to have each of the panelists introduce themselves and give a little bit of background on themselves, and then I will have Lisa hand it over to Lisa for a 10-minute lightning talk. So let's start with AJ.
Hi, good morning. My name is AJ Williams. I'm the founder and executive producer of my company, AJ Events, and I'm here to provide a different perspective as a fundraiser who I've raised over 75 million over the course of my career. So I see the front and back end of funding and fundraising. Thank you for having me.
Well, hello, everyone. I'm Raza Sheikh. I'm one of the managing directors at Launchpad Venture Group. Launchpad is an angel group in the Boston, New England area. We're about 170 members, and we invest early stage in all sectors, but focused around our geography. I also co-manage Beacon Venture Partners, which is a VC fund, also investing at the early stage. My background is technology and software, and I switched from being an entrepreneur to an investor a little while ago, so I can relate to what you guys are thinking today, and hopefully be able to answer some of your questions.
Hi, everybody. I'm Lisa Frusteyer, and I invest both individually and through funds. My background is in technology. I'm also currently coaching, and I just became an adjunct professor on funding for new ventures. When I started out, because of my because my background was in technology, that's where my investment interests gravitated. But I quickly was really taken aback by how inequitable the early stage funding environment is. So I have learned a lot about it, and now my investments focus on how do we channel capital to underrepresented founders. And that means most people. So it's people who have underrepresented companies or who are part of underrepresented demographics.
Great, and we have Kristen joining us virtually.
Good morning, everyone. Great. Well, I can't see you, but hopefully you can see me. It's like to be here. My name is Kristen King. I am head of group management for Boston Harbor Angels. We are an angel investor group in the Boston area. We focus mainly in the US and Canada. We are industry agnostic, but since we're in the Boston area, we have a lot of biotech, and we typically do early stage and then follow our companies all the way through, supporting founders. We have a passion as well to support female founders. And then in my other hat, I am the VP of Corporate Development in M&A for a company called DefibTech. We focus on cardiac arrest. So I'm here today to kind of give a lens on both sides of the perspective and look forward to our conversations.
Awesome. And I'll give a quick bio on myself as well before I turn it over to Lisa. So I currently focus on venture debt for life sciences companies. I previously was a founder myself of a company called Life Science Nation, and I'm also on the advisory board of an exciting company called CircNova, which is developing an AI engine to generate non-coding RNA therapeutics. With that, I will hand it over to Lisa.
All right, thank you. And I think we already have a really great range of perspectives here. I'm going to really paint a picture of the funding landscape. And then what I'm going to do is give you some tools to narrow it down to figure out what is the right kind of funding for you if you're a founder. So first of all, show of hands, how many people in the room are founders? Okay. And if you are a founder, have you raised money before? Okay, so the majority of people who are founders have raised. If you've raised, have you raised equity?
consider convertible equity?
Sure, that counts. Okay. All right, this is really good background. And then of the people in the room, how many are investors? Okay, so at least one person or a couple of people wear many hats: investors, founders, equity, fundraisers. So what I'm going to do is just give you a snapshot of what is the funding landscape looking like right now. What's the environment that we're in? And it's important to understand what is sort of in the air and what investors are thinking about when you go out to raise. Then I'm going to paint a picture of what the overall funding options are, and then again, give you some tools to parse that so you can figure out what's right for you. After COVID, we saw a huge spike up in dollars invested and numbers of companies supported. That has since died down. This is quarterly data. You see the bars on the right. It's still a little bit early to tell exactly what's going on, but the environment has definitely softened. Interestingly enough, we're starting to see a big increase in the number of down rounds. So the 15% on the far left is the percentage of down rounds in the latest quarter. We haven't seen that many down rounds since 2017. And it's a signal, maybe, I hope, that valuations are coming back to normal. This isn't necessarily a bad thing because valuations were pretty inflated. The other interesting thing that we're seeing is more time for early stage companies. So angel, seed, early stage VC, more time between founding and funding. And that I see anecdotally on two sides. It's investors who are asking for more traction. Again, not necessarily a bad thing, but it's also founders who want more traction because it puts them in a better negotiating position. So that's kind of what's been in the air. All right, how does this affect you? In other words, why should you care? Because we're all sort of subject to trends. We want to know what the dialogue is. But if you started a company, chances are you did it because you like the product, you like the sector, but it's not necessarily because you wanted to become an expert in financial services. So when you take your company, you want it funded, you're really crossing over into another area. And you do need to learn the language of financial services because your investor speaks that language. All right, so what are your funding options? Here are some of them. This is a crazy chart. There are so many options here. So how do you make sense of them? These are plotted in terms of the range of potential investment size from low to high and investment cost. Cost does not necessarily mean only financial cost. It's the effort required to get that source of funding. It's the commitment to return that you make when you take on that source of funding. And it's also potentially cost in terms of equity that you need to give up. So, institutional VC up on the upper right, you're going to have to give up a bunch of equity if you get VC money. There's also potential high financial return. And then down on the lower left with grants, generally they're non-dilutive, which means you don't give up a piece of your company. So the cost to you is relatively speaking lower. So that's the map, right? All right, so where do you start? What I'm going to give you is a couple of key decisions that you need to make when you embark on your funding journey. And then what are your interests that you need to be aware of and that you should be protecting? Some key decisions. You have to know yourself. You have to know yourself as an individual. You have to know yourself as a company. What kind of company are you? Are you poised for explosive growth? Are you in an industry where there's a really active exit market where it's rational or reasonable to have an IPO? Maybe yes, maybe no. There's nothing wrong if the answer is no, because depending on your goals, if you do want a big exit, you have to start planning that at the outset. It's going to affect how you manage the company, how you staff the company. It's going to affect your entire strategy, and also your funding strategy. So you need to know the answers to these things. Maybe you want to run a long-term business that's growing 10, 20% a year. That's fantastic. But you have to know that, and it affects the kind of funding that you're going to look for. So that really covers those first two things. And then who do you want to be working with? What kind of partners do you want to have? Your funding partners are so fundamental to your business And hopefully you're going to be working with them for a long time. So do you want a partner who is maybe a joint venture partner, or do you want that partner to be a VC? If it's a VC, they're going to want a board seat, and it just means entirely different things. You have to know the spectrum. You do need to know how to protect your interests. I'm going to define what I think of when I say, what are your interests? And you do need to look for a funding source, but they're not all the same. You need to look for a particular funding type, but you have to understand the particular terms that you're taking on. One convertible note is not the same as another convertible note. So these are these are starting decisions. Even before you're out there raising, you have to kind of understand what these all mean. What are the founder interests? Things like maintaining equity so that you get both the potential financial return, but also so that you maintain control. You might be willing to give up equity, but what do you get in return? And I have a little handout with these criteria in case anybody wants to take them later. Of course, you want a reasonable cost of funds. That's both the financial costs, the logistical costs, and these are knowable things. You can start having the discussion. You want to optimize your cash flow, the right amount of cash in the right form at the right time in the right place, so that you don't impede the progress of your business. And by the way, depending on how you raise, it can be just as bad to raise too much as it is to raise too little. So how do you optimize your cash flow level? You want an approval process that is not going to put the brakes on your business. For a lot of people, raising money is a full-time job. And you also need to understand what the investor expects, but to be able to say, no, this is not management. It's okay as a founder to say no to some requests you get when you're going through the approval process. Supportive investor relationships come in many forms. It could be somebody who introduces you to a potential customer, somebody who has a vision for where your business wants to go. And then if people think of others, let me know. Okay, so in organizing that crazy chart, basically I'm categorizing things into dilutive funding, which means you do give up equity, i.e. your equity stake, your ownership is diluted, versus non-dilutive. Sometimes when we think of startups, we immediately think of equity funding, but there are a lot of other options that we're not going to go into right now, but they can be extremely attractive. They allow you to maintain control, and they don't imply a commitment that you're going to generate a certain return. So by all means, explore the non-dilutive options. And then finally, as I said, we're in a sort of uncertain environment. So this is a great opportunity. Know what your story is, what is the story you want to tell before you even start on this journey. Know your interests and how to protect them. Understand there are many, many options open to you, and we're going to be talking about some of them. So thank you.
Thank you, Lisa. Some great points, I think, made, especially around, partnering with the right investor. I can tell you from personal experience right now, I'm in the process of helping a company raise money, and we're actually saying no to a lead investor because we don't think that their sector aligns well with, our end goals. So I think choosing the right investor is, so important. In addition to that, I feel like a nice thing to note as well, I feel like I've been on panels the past year and it's been all doom and gloom in terms of the outlook. I will say that we've started to see fundings pick up late August, early September. So it seems like things are starting to happen again from a funding perspective. So that's all positive news. So I'm going to start with the question portion of the panel now, and then we'll get to Q&A at the end if we have time. So wanted to start off by asking when the panel thinks that it is, when is it too early to start pitching investors? My personal opinion is it's never too early. It's the old idiom, I'm sure you guys have heard it 1,000 times. Ask for money, you get advice. Ask for advice, you get money. So I personally think it's always good to pitch and get investor feedback. but would be interested to see what the panelists think. So let's start with Raza.
Well, I think first you have to kind of distinguish between a fundraising pitch and sharing your idea for feedback or advice, as Daniel was calling it. When you're at the proverbial, PowerPoint 2 engineer and a dog stage, you can't really pitch investors. You at that time need to find believers, friends, family, and fools category. But as you progress, I think I totally agree. It's never too early to start talking with investors, not necessarily, formal fundraising pitch. And I think that's when you kind of build those relationships. For most companies, let's say non-life science software or tech-based companies, when you get to your demo, your MVP, you're starting to get into the market, you got some downloads or some users, or I think those are probably the right times to start chatting around and find venues where you can talk to more investors at the same time.
Great. And Kristen?
Okay, great points. And I'd follow that with saying, as Lisa said it, when are you ready to give up some equity, or you're even thinking about that? So it's always great, as Raza mentioned, to get advice and feedback. But really in your mind, if I come from both sides of this, you should be at a point where in your head, it doesn't have to be all perfect, but what is your path forward from a financial point, and what are you looking to do from an exit point? If you're going to pitch angels officially and you want to get on the docket, I'll give you the BHA process. You should be ready enough to pitch. You get one shot. And if you're at screening, you're up there against a number of other companies. And then when you go to the next stage, if you get selected, you need to have your diligence wrapped up. You need to have that path forward to speak to investors in a financial way and an idea of deal structure. So that's what I'd recommend as far as being prepped to go talk to angels.
Yeah, that's definitely a very good point, knowing the deal structure, if you're going to be tranching an investment potentially. So how about you, AJ?
Well, I think before you pitch, you should definitely build a really strong strategy around your pitch deck and who you're going to be pitching to. So the strategy is really, really important. I would definitely conduct a lot of research in regards to the same type of companies that that's based on your startup, and then look to who is funding those same type funders, and then start to really build on, the one thing you can do is really talk to those potential investors and really hone down on why they're giving dollars, so you can build the right strategy for your pitch. And I think that is really important.
Yeah, it's a great point. I feel like too few people do their homework on investors and look at an investor's portfolio to figure out, A, do I fit in it? Or B, do they potentially have, a very someone who is a competitor in their portfolio already, which may or may not be a good thing. But Lisa?
Yeah, just jumping off on a couple of the points. Do your homework and find those investors, but it is time consuming. I mean, it just is. You're going to have to do the legwork, and the onus falls on the founder in that way. The other way that I believe the onus falls on the founder is it's the founder's job to drive the discussion and to say, if they're looking for money, make that really explicit. And it might be awkward at first, but you save your time. You save time by not doing that dance around, am I talking to you for advice or am I talking to you for money? Just ask explicitly. It's really good practice.
Yeah. And so how do you come up with your fundraising ask? Let's start with Kristen.
Yeah, great point. And maybe why I was focused so much on knowing that path to exit. I mean, we've all seen it. It's a tough time out there to raise money, but there is funds. There's funds waiting for the right strategy. And I think I heard it best at a conference where It's not like this is new. Things have gone back to that more process around needing some diligence and really understanding what you're chasing. So for the fundraising strategy, make sure you have enough to get to the next inflection point, and then a little for what is next. We see folks come in and they're just focused on the now. And then the big worry is, are you even thinking about the next phase? Otherwise, as a CEO, you're just going to be chasing from one to the next. And the whole point of talking to investors and coming early, we'd welcome those conversations. Deal structure is kind of what we do, and it's overwhelming sometimes to think of that whole path and dilution. What's going to happen to your share? So really being able to understand that, and if you don't know, ask. Folks are definitely willing to help, because in the end, it all comes back, and it's just a win-win situation for the whole ecosystem.
Yeah, I think those are great points. Yeah, know how much you need to be raising to hit your next milestone, especially because you do not want to be running on fumes, which unfortunately I feel like a lot of companies are doing right now. So great points. AJ?
Well, I would say that when you're asking for fundraising as a fundraiser, my strategy is always to ask negative questions of why they don't fund. So you can handle those objections when you're pitching. I think it's really important to ask questions before you pitch. So asking those negative questions, and I specific quoting negative questions, so you know how to handle the objections when you're pitching. It really works to your benefit, especially if you're prepared. So you can, best target, tailor your pitch to the investor.
It's a really, yeah, good point. And also asking like why you, if you don't ultimately get funding from them, why not? So then you can follow up and eventually tell them, hey, I did hit that milestone that you wanted to see.
Right. And also, when you're tailoring your pitch, it's also important to have those points that you can dangle that carrot to that potential investor, meaning what's your niche. Obviously, I think that's obvious, but it's important to state that you want to make sure that you tell that particular team or investor what separates you from the different type of companies, and not even companies that are like you, because when you're pitching, you're pitching when you're pitching, you're not only the investor's not looking at giving you dollars for startups that are similar to you. You're advocating for just dollars in general. You're competing against everybody. So you want to make sure that you're pitching your niche and what separates you, and what aspects of your pitch, or what in your startup, and even the people that are behind you, your team, what separates you, so you can dangle that carrot in front of them.
Yeah, it's a good point on competitive analysis, because that also can help you come up with comps, which can be used to show, what valuation you may be expecting. Lisa?
I think it's important to understand the concept of investable. A company might be backable, people might like it, but is it investable? And I think you save a lot of time by figuring that out. So what's the distinction? Investable means it's going to be generating a certain presumed return and set up to do that. And again, that goes back to, you might be a tech founder and you have to understand the rules of the game in financial services. That's just one example.
Raza?
Yeah, I mean, the question is like, how do you figure out how much money to ask? And I think as Kirsten started, you start from the end goal. Startups are, doing the onion theory of risk mitigation, where you peel one layer and then the next and so on. And each tranche of money or each round is going to get you to mitigate some specific risks in that startup. What you do really is to figure out what are the meaningful goals that will take your startup's value up the next quantum. For example, IND submission to FDA. Once you've figured out what are those meaningful goals, you work backwards from that, and you typically need 18 to 24 months of proverbial runway. and you are figuring out the people, the product, the things that you will need to pay for those 18 to 24 months. Add that up, add some buffer, and that's kind of your number. Meaning it's not arbitrary, hey, I should always just raise 3 million for the first round versus a million. And then a very important point is the overall long-term capital staging as well. Not only you have to think about this immediate round, but you also have to think about the next and maybe one more round, at least in the outline, saying how much money would I need for the next set of goals. And kind of that's a really important consideration for investors in terms of capital staging plan of a company. So yeah, basically, work backwards to figure out how much money should you be asking.
Yeah, that's a very good point in terms of the cash runway lasting 18 to 24 months. So for venture debt, we typically come in on the heels of the last equity round, and we always want to see at least 12 months worth of cash life. But I would say for the most part, when we do come in, which is usually post A, post B, we do see 18 to 24 months, which gives us a little bit more comfort if we're lending them money pre-revenue. So how should companies prepare for the valuation discussion, and what advice do you have for negotiation? AJ, do you want to start off on this one?
Sure. It's important to understand what terms you want out of your, from your negotiation. So I would just, because I think as I think the terms for your what you're looking for as a startup is important. So understanding what your terms are going to be would be, the best for negotiating the best for whatever you would like for fundraising. And
Yeah, and that's a good point. No common terms. There's a number of different resources. New England Venture Capital Association, I think the Venture Capital Association, the national one, has kind of like standard term sheets that you can take a look at, so you can get a feeling for what terms usually look like and what you should be expecting to see on a term sheet. So that's a great point. Lisa?
Yeah, just to echo what AJ said, understanding what the implications of your valuation is really, really important. High valuation is not necessarily good. And I'm going to tell you the story about how a multi-time founder negotiated her first venture deal. And she said, I'm willing to give up 20% equity. Willing to give up 80% equity, which is kind of standard. And you tell me what you think the valuation should be. So she very deftly avoided the discussion of numbers, and yet threw out a number that was sort of industry standard in terms of the amount of equity that she wanted to maintain. So I thought that was a great approach.
That is a good approach. And I would also say I've seen a lot of companies, and a lot of companies have asked me if they should get a fundraising valuation. And I would say that if you're very early stage, I don't think it's worthwhile. And I'd be interested to get your feedback on this from the panel as well. But I would say don't get a valuation if you're fundraising, because usually it's going to be a discussion between you and the investors. And so it's not really a worthwhile exercise because it'll cost you about 30 grand. So
Yeah.
money could be spent better elsewhere.
I mean, valuation can be a hot button issue for founders because they've heard in the news that so-and-so raised at this valuation or that valuation. When you're early, there is no real way to value a company other than what the market decides, what you and investors can negotiate. One key thing that you as a founder have to really understand, to Lisa's point of why high valuation may not be a good thing for you. If somebody is offering you $1 million for 1% of your company, that means they're valuing you at 100 million. Let's say you're at the earliest stage and only have the PowerPoint slides. You take that million and you have to make enough progress so that once that $1 million is gone, your company is worth more than 100 million somehow. That could happen, but really that's called the growing into your post-money problem. It's one of the very most important fundamental reasons why the valuation has to be kind of market. It has to be something that allows you to use that money. That money will be gone one day. At the end of that, when the money is gone, that you have built a company that's more valuable than the lost post-money valuation. The other couple of ways that companies are valued at the early stage is really that, which is the metric of post-money ownership for the investors that they desire, or what the market is for those type of rounds. And that, with simple math, can kind of give you a rough idea of the valuation. So know what the market is going on for your round, for your industry, for your type of stage. And that gives you a good idea for what you should be negotiating for valuation.
I feel like people do not talk enough about raising less money in down rounds. And that, to Lisa's earlier talk, that's why, we're seeing a correction now. So many investors are now saying flat is the new up in terms of the current environment. So I think about taking a reasonable amount of money that you actually need versus what's available is very important. Kristen?
Yeah, all great points. And I know it's a lot, but when you think of valuation, if you want to look at it an example, and this is why I said path to exit, you've heard from the panel, more is not necessarily better, because in the end, you are the founder, you own common shares, you get paid last. So when you do the math and at every round you're going to be increasing, it's really important that you see, what am I comparing to for an exit, or have that target in mind. Because if the math builds up where you're going higher and higher and higher, and then you exit and you only get 1.5x, you have to look back and go, dude, I give away so many options that there's even enough money to pay everyone out. And then if I put my M&A hat on, not all deals are just cash up front. So it's a mix of a little bit of upfront, a little bit of earnout. It could be. So when you think of it, I know you're early, but you have to just do that high level and try to figure out that you have enough not to dilute yourself and others out of the game. And then also make sure that you have enough valuation where you are in touch with the type of investor group you're reaching out to, and know in a general, if you're going for angels, there's kind of a threshold. If it's a venture, there's a different threshold. So it's a matching game, and you have to feel comfortable and play the scenarios. I love Excel. I'm an Excel freak, but play some scenarios out and then ask some others for advice, so you have an idea and some backing behind your valuation. Everybody can do forecasts and roll it out. It's not that different than corporate. I mean, we have to pitch for money for budget. So I think it's important to have some sense beyond what the science and the tech is just worth in numbers.
Yeah, and those are some great points around dilution as well. You can I believe Carta actually has on their website metrics around what founders are typically left with in terms of equity based on round. And I think folks would be shocked at how little equity a lot of times founders have. So good to look at those to get a better understanding of like where you're at in terms of dilution. Are there any common missteps that you all have seen in investor pitch decks that founders should avoid? My personal pet peeve is asking for an NDA before even looking at a pitch deck. But yeah, would be interested to see your thoughts. Lisa?
One of the things that I think can be challenging is getting really, really fluent in the financial implications of what you're asking for. Because you're talking to an investor. You're managing the company, they're managing their portfolio. And it is, it's a different domain for a lot of people. So never, ever, ever hand off a discussion of the financial implications of the business to the fractional CFO. It should be the top management of the company who understands that. I'd say that's one thing. And just, it's not high math. It's not complicated math. It's just really having an intuition for what drives the business, what that matters, what your key levers are. you can do that. And I think it's very important.
It's a great point. I mean, I'm in the life sciences space, and I can only imagine what would happen if you allowed for the fractional CFO to pitch the science. So that might be very problematic. Raza?
So piggybacking on Lisa's point, I think overall the general pet peeve is not building that narrative. And we expect the founder and the CEO to be carrying the entire narrative, the problem, the solution, the market, the go-to-market, financials, as Lisa mentioned, and then all the way to exit. Why would somebody buy you? So that's the most common pet peeve, that founders haven't covered all the bases that investors want to look at. And then maybe I'll just put a few, smaller and specific items. One of my favorites is whenever I see the term CAGR in there, I kind of think, well, this is just like some MBA exercise, so it doesn't have anything to do with the real world. And another small one, but important one for me is whenever I see year 1, year 2, year 3, year 4, I'm like, well, this founder is totally uncommittal. Like, when does year 1 start? So you have to put 2023 and so on. But just as a couple of examples, but usually pitch decks are super fun.
They are. It's always fun to get like the 100-page ones too. Kristen?
Yeah, speaking of the 100-page one, so a couple of pet peeves. If you've got 30 pages of science and then you just have one on the deal and use of funds, and just try to be able to pitch your story. What if your slides don't come up? I think the best pitch I saw, the slides didn't work, and I could visualize everything that CEO was saying. He was crisp, to the point, covered the facts, and really, if you're not the one that's the most passionate, if you bring your team up, make sure you play your team right. It's how do you lean in and get folks excited about what you're doing? And then lastly, just be prepared with that diligence afterwards. If it takes too long for things to go through diligence, investors are seeing new deals all the time. So just be prepared with the backup as well. You don't have to tell everyone everything all at once.
Love that, showcasing the team. Also, I think it's always extremely helpful to tell the company's story. AJ?
Well, I'd have to say that make sure your pitch deck is easily understandable. Make sure it's clear and concise, and it doesn't have a lot of idioms or words that people just don't get or understand. If people don't understand your pitch deck, you've lost them. We've seen this 100 times when we receive pitch decks from the clients and the nonprofits that we work with, and we always have to send the information back for new content. So just make sure that your pitch deck is easily understandable, visually stimulating, and again, I like to say this all the time. You want to make sure that you're creating that anticipation for what's coming next. So make sure that you are prepared to answer any questions from the pitch deck that's there. Make sure you're really, really prepared, and make sure that your content is impressive.
Yeah, that's a great point on kind of knowing your audience. For example, I'm sorry, so many examples in the life science space because I'm biased, but if you're on the scientific side and you're pitching a non-scientific investor, maybe not best to use words that are like 40 letters long.
Yeah, and also make sure that there's not too many small font and a ton of words that are in the pitch deck. Because when I look at pitch decks or PowerPoint slides, and there are just so many words and the font is too small, you're also losing that person because they're already frustrated, from looking at the deck. And again, it's just not clear and concise, and not, it's just frustrating. So just make sure that your pitch deck is also aesthetically, easy to read.
So what's the best way for founders to get in front of investors, and what type of introductions do you think are most valuable when it comes to getting on an investor's radar? I personally think getting introduced via one of the, in the case of a fund, the fund's current portco's management team is always very, very valuable. But would be interested to get the panel's thoughts. So Raza?
Yeah, so I mean, Lisa's chart was very good that there are many, many kinds of investors. So if you were, hey, how do I get out to friends and family, you don't want to have awkward Thanksgiving dinner, so you may have to do it in a certain way. Individual angels, they're all in the community around you. You can find them. Many of them have been founders. And usually they are also very open to, having a proverbial coffee these days, probably on Zoom, and be able to listen to you. The next step up from that is finding opportunities where there's a one-to-many situation, where with one pitch, you can talk to multiple investors. One example would be Launchpad runs a Catalyst event, which is run about 10 times a year. So roughly about every month. And it's 8 to 10 companies that have a quick pitch, 5-minute pitch, 5-minute Q&A, to usually, 30 to 50 friendly angels show up to the event. And that gives you an opportunity to really share your story. And from there, people that might be interested emerge. And then I think finding other founders is like a really terrific suggestion for portfolio companies to the target investor base, is a really good idea. I think almost everyone takes cold inbound, at least looks at it, because people don't want to be having the bias of only funding their network. But a warm introduction certainly helps, in the sense that they're kind of pre-filtered. Events such as Startup Boston Week is a good place to run into investors, and finding other ways of getting in front of them is always good.
100%. This is a great place to network, so I encourage everyone to do so. How about you, Kristen?
Yeah, I think, wow, so many things, great points that have been said. I would add just getting out there and going for those competitions and being able to pitch in front of others. That's great. And then also leveraging and make sure you know how to the networking skill. If you're going to go out and you hear speakers, even from investor groups that are talking, and you go up and meet them, have your story ready. Like that's just the one piece. Always be ready to get people excited when you go out and meet them. I think the other stuff has been covered. We're all open to meeting you. Get excited when you're ready to meet people and network on the spot. You're constantly selling, like just. Yeah. I mean, even the family, just be practice.
Yes,
so it's just in your head, just comes out, right?
AJ or Lisa, do you have anything else to add? I know we covered a lot already.
Very quickly, Boston does, I think rightfully so, have a reputation for being receptive to founders. This is a great city in which to get tapped in. And then I'll just say one thing. So I was affiliated for a long time with the Capital Network, which is now partnered with another organization. There was a founder who went through there who did cold outbound emails and got a 90% response rate. So if you want, and we decoded it with her. So if you want an example of it, I'm happy to share that afterwards with you.
I want to see what that cold email looks like. I'm not going to lie.
I think the most likely reason was that the target investor list was correct. Inbound LinkedIn cold, I get, for example, like 100 every day. But if it's a Boston founder in the sector, I am going to respond. So I think it's again the targeting and the matching.
And then I'd like to add attending events, not just the founder or startup events, but also fundraising events, charity events are also key. That's where a lot of deep pockets and a lot of investors, individual donors attend. So, being able to network and pitch your story, meet people, hobnob with those potential investors. They can also introduce you, if they like your story, to other people. I've seen that happen at many of my charity events where startup companies are linked to individual donors or investors at these events. And your common interest is that cause. So you already are starting to build that relationship.
Awesome advice. So I'm gonna throw out a last question because we're getting close on time. What's the top piece of advice that you give to founders that are fundraising? My advice is the fundraising environment's terrible right now, and if you're a first-time founder, it can only get easier from here. So great news, AJ.
Well, I would say that you always should have in your head that not all money that you receive is good money. And you should, once you have that investor or investor group team, you should always cultivate that relationship the entire time. You don't know, you don't know when once you're looking for more money, it gives you the opportunity to better target your pitch for new dollars or increased dollars. That is my biggest piece of advice, because you want to make sure that you are continually establishing a great relationship with your funders, with your donors, and cultivating that relationship. Open lines of communication are always key, because if you don't communicate with them, something happens, they talk to other investors, they can gang up on you, which is why not all money is good money. Always keep that in the back of your head and continue to communicate and cultivate your relationship with your investors.
It's a great point. Diligence is a two-way street. I think a lot of people don't think about that. So you need to diligence your investors just as much as they're diligencing you. And, the partnership is similar to a marriage. So it is important to work on the relationship. Lisa.
Start with you. In other words, funders should start with yourself. And it goes back to some of those questions that I showed earlier. Know what decisions are right for you, know what your goals are, know how you play, how your company plays in the market, but just really start with your interests and your goals.
I'll piggyback on the marriage point. I heard that the average length of a marriage is less than the average length of your relationship with investors. So do pick your investors wisely. You'll be stuck with them and you can't get a divorce. I think the real message behind that is, I think it really is an inefficient, imperfect, but a matchmaking game. So know that and try to find the best match for your investors.
I'm literally going to get my marriage license after this. So this is a very apropos conversation. Thank you. Kristen?
Yeah, I think everybody said it so eloquently. I know it's a lot of work, but it is about fit. And coming from the angel world, I mean, BHA has been around 20 years. Folks are doing this, myself included, because we want to feel part of. We want to share everything we've learned to support our founders and to answer questions. There are no silly questions. There are no stupid questions. And the funding and finance piece, you can't know everything. So the other piece of that is, like I kept saying, that, path to exit. We're in early and following all the way, and you want to feel comfortable, as you've heard from the other speakers, with a group that you can be transparent about. We see that now with the markets, right? A down round. How do we tackle that? And people in groups have gone and seen so many different deals that they have great advice. So find a group that you feel comfortable going on that journey with.
Yeah, I mean, I feel like everyone in the Boston ecosystem is so willing to be helpful and lend a helping hand, especially if they're former founders. So I feel like, tap into this ecosystem. We're so lucky that we're all here and building companies here. So yeah, and with that, I'll turn it over. And if there's any Q&A, do we have any questions?
You all absorbed
online?
everything, right? So, okay. So what dating question do you have for Raza? I'm kidding. Come on.
Hey, Shazab Lara, thank you so much for the transparency and it's great advice that you all shared. Question around, of course, the founder carrying the narrative, super important, right? And understanding and taking that forward. If you're going to hit on some key success factors that you look at in founders? Is it domain expertise? Is it industry expertise? Is it go to market? Is it proof of concept that's already there? I mean, what are some advices in terms of prioritization? Because there's a lot to digest, right?
I'll give it a crack. So founders are like a special bunch. We're looking for like really a lot of things. Somehow investors really put importance on the team and the founders. People say it in so many ways, but there's a combination of 3 or 4 or 5 things that are most common that people are looking the signs for or track record for. EQ, IQ, they have to be smart people. Persistence and grit and resilience, they have to be able to, go through a lot and things change no matter what. They have to understand the problem and the customer better than anybody for that problem. And lastly, they do have to have some industry knowledge as well. They have to be able to have presence, be able to manage people. In some ways, this sounds silly, but they're simultaneously at both the extreme spectrum of extrovertedness and introvertedness, where they can, come up with a vision. So these are super special people. We put a lot of list of things that we look for and try to find those. And I think many of you in the room are in that category.
2 really quick things. One is in the presentation, having a really strong appetite for questions and challenges and enjoying that. I mean, you'll see founders sometimes. They look like they're having the most fun of their lives when they're being challenged. And then also being able to test hypotheses and assumptions. Not everything is going to go right. You know that for sure. So painting too rosy if a picture is unrealistic, and there's an opportunity in talking about the problems that you've overcome.
Excellent. We have another question over here. What's your name, miss?
Hi, Rebecca Moore, and I wanted to mention 2 other resources to practice pitches. One is Scroobius.com and also the Entrepreneurs Forum. But my question is to Raza, and that is, if a founder goes to Catalyst, for instance, and has a pitch that's compelling, but their valuation is too high, have they shot themselves in the foot, or can they go back and adjust it?
Catalyst is built as a networking event more than a fundraising event. So we're not even talking about the valuation at that moment. Catalyst, you're kind of vetting the appetite. You're saying, hey, this is what I'm working on. Are you excited about it? What we do afterwards is a follow-up scouting meeting. And we'll talk a lot more detail, where your company is and maybe the valuation question if you're fundraising. But in the end, if you're not either yet ready or it's not a fit, that's not, you've not lost your shot for that reason. It happens many, many times that the company that we met at Catalyst, we funded 90 days, 6 months, even a year or 2 later. And it's always a process. It basically gets the dialogue, the relationship going with early stage investors. Catalyst is an event that Launchpad runs 10 times a year, and we invite 8 to 10 companies. It's a 5-minute pitch, 5-minute Q&A. 30 to 50 investors show up, and it's just a fun way to share your story.
Got another question here in the back. What's your name, sir?
Hi, Malloy Kundu. So I know a few of you. So question is about venture, well, I don't know if they're venture, but let's say pre-seed/seed funds that express interest, but they say their MO is that they follow but don't lead. How would you suggest that entrepreneurs
I think that is an interesting and common problem at the early stage, where you will find investors that don't either prefer or don't have the capability to lead around. That's another filter or thing that you have to research about potential investor, whether they have the capability to lead. Launchpad does lead rounds, and we're very adept at doing that. 21st year, 160 companies, and led many, many rounds and have a good term sheet. So what you do as a founder is you keep them warm, and even if possible, get their soft circle saying, all right, how much are you in for? And then continue your search to find the lead. And once you have the lead and a round with terms, by the way, that's what typically means. What does a lead mean? They may be writing a significant check as a portion of that round, but more importantly, they're the ones who are setting up that capital staging plan, that term sheet, and the terms of the round for everybody else to say, well, we can come in on that round as well. So it's a really good question, and founders should get more educated about it, on how to find a lead investor.
Yeah, I feel like it's always easy to find people that will follow, but it's very difficult to find a lead oftentimes. So
You can also talk to serial entrepreneurs as well, because they're really good. They have really great contacts for potential investors, like a Paul English or an Alex Stern, Leslie Williams, who's one of the biggest names in biotech. They would, people like that are really great resources for investment contacts.
Excellent. Thank you for these poignant questions. While we could talk about this topic for quite a long time, we only have an hour for the slot today. However, I know that they're very nice people and they like to open up their digital inbox to everyone and love to chat afterwards.